Hey everyone, I am David Safransky. This is Financial Revelations, your one-stop shop for financial news and information. You could always get to us on Twitter at skibucks, the number 1-800-344-2534 is our phone number. All of this will be scrolling, so if you didn't write it down, don't worry about it. And then on Thursday mornings, every Thursday morning from 8 a.m. to 9 a.m. until they fire me, I am on WCRF 103.3 in Cleveland. It's a Moody Radio station. They have an app. It's really good. You don't have to be in Cleveland to listen. You could go on the app and listen from anywhere. And I'm pretty sure the shows are cataloged there. So if there's something that you just have to hear again, you could hear it there. But you could always call here and ask us directly, 1-800-344-2534. And if you'd like to email Corey with questions, comments, if you have something that you'd like us to talk about, we'd love to hear listener comment, and that's what we're going to do today a little bit. But you could email Corey. It's K-O-R-Y, Corey@EPSF.com. And again, that'll all be scrolling below me. We have this new background here that we love. Things are really looking up for Financial Revelations. So we have hit the big time. And we appreciate everybody listening. We can see where, we don't know who's listening, but we can see where from. And we get a pretty diverse audience by country and continent. It's interesting to see these metrics. I had a boss one time that said, if you can count it, count it. If you can evaluate it, do so. So we look at those things, every so often just to see what the impact is like. So thank you for watching, listening, however you do it. We're on YouTube and, of course, Apple Podcasts and things like that. We also do a quick hits a little bit. It's about a minute and a half, 2 minutes, where I'm sitting at my desk or I'm reading something and I say, hey, you know what? I want people to know that. I'm going to try and do it once a week. So look for the quick hits also because it's very short and usually some what we like to call actionable intelligence that you could use maybe in your portfolio, or at least consider. It's something to consider. So I want to start off. I just want to go back and talk about the Fed just for a minute. I know we do this every week, and there's a reason. Because the Fed is in the news every week. And since we last did a podcast, there has been a ton of Fed speak. Fed speak is when Fed governors come out, they get interviewed. They're generally pushing a narrative of some kind. And you could see that relatively quickly in the interview, what they want to talk about, because they're not going to talk about anything else. And if there's things that they don't want to talk about that they get asked, they just won't answer those questions and they'll go back to where they were. And there's been a lot of hot inflation data that's coming out too in the last week. And I got to be honest, the bottom line for me is the Fed is going to go higher and probably longer. I think that they did make a calculated error in the 1st of February when they only raised by 25 basis points. I think they were trying to appease the market, hoping for better data. But the thing is that the Fed has a lot of this data before it comes out. So they know the data, not all of it, but a lot of it they will have, or they'll have parallel data to what's coming out because they make businesses fill out surveys. I get a survey from the Fed. If I don't fill it out and send it back, I get fined. And a lot of businesses have that. And so they want to know things. How many people are you employing? What is your thoughts about the future? So all these things. So they get this employer data right from the source. They have it well in advance of the ADP or anybody else. And so I think they're going higher. As of this morning, as of the taping of this broadcast, and this is going to change on a daily basis, so you have to look. The 1-year government bond, the 1-year government note is at 5.1%. I haven't seen that in a long time. That's going higher. And that isn't necessarily a bad thing. It's not great for the stock market. And that's one of the things that we're going to talk about today. We had a listener question about what do I like better, bonds or dividend paying stocks? And for a long time, the answer was easy. From 2007 really to late last year, you had to buy dividend-paying stocks because a 5-year government bond was paying 1%. Well, I can't lock somebody up for 5 years at 1%. So we had to get creative and do different things to get some yield and drag some risk out of portfolios. Sometimes if there was an annuity, I know I know how you guys feel about annuities. I feel the same way. Very niche product, very overused. And if you go to an annuity salesman, guess what you're going to get? The same thing you get if you go to a transmission shop. Your transmission is broke because that's the only thing they fix. So your transmission has to be broke. If you go to an annuity salesman, you're only going to get an annuity because that's what they sell. So if you're going to use somebody in the financial industry, use somebody who's broad-based, has a lot of product. Maybe they have annuities, but they use them as they're supposed to be used, niche-oriented product. So we had to do some creative things, and every once in a while there would be an annuity company. There's one annuity company that I hate. I just absolutely hate them. My staff hates them. Not the people there, just the company. We love people, but this company was horrible. They treated us horrible. They treated our clients horrible. But they paid a huge guaranteed rate. And so we used it like a CD, especially with qualified money like an IRA. You could go in and come out and go right back to an IRA, no tax consequence. So it was an easy thing for us to do. But heaven forbid you needed information from that company because you just weren't getting it. And so consequently, we don't use them anymore. They got bought by somebody else anyway. But even if they did come back, I wouldn't use them. So since 2007, though, it was really stocks. You had to use stocks, dividend-paying stocks. And there's some big names that pay really good dividends, and so we could use them, not a problem. There was some risk associated with it because those stocks, they go up and down with the market too. But mainly, you were getting a 4, 5, and even sometimes a 6% dividend out of these stocks with a little bit of risk. We could take that. We could do that. So I did that for a long time. Now, dividends, ordinary dividends are taxed as income. That's it. They're just income taxed. Qualified dividends, which are a little bit different, those are taxed at the capital gain rate. So you can get a little bit of tax preference on a qualified dividend from a publicly traded company. And you could look for those. And so you get a little bit better of a tax treatment. Bonds, on the other hand, if you own a treasury, so something from the federal government, there's no state or local tax on those. So whatever your federal income tax rate is, that's what you're paying. So if you're in a high tax municipality like Hawaii, New York, Vermont, Washington State, Oregon, what do those states have in common, by the way? Just asking for a friend. Run by Democrats. Why do you think everybody's moving to Florida? There's no state income tax there. I was just in Florida. It's getting crowded. There's still a lot of space. They'll keep the lights on for you, but it's getting crowded. Now, if you own a muni bond, a municipal bond, those could be triple tax-free. So if the municipal bond was issued in the state that you live in, the county and the city that you live in, it's triple tax-free. So I have not really found a lot of great deals on municipal bonds lately. They tend to be a little bit longer hold periods, and they're a little pricey still. So there's some room for them to come down a little bit. I have not bought a lot of municipal bonds. And then there's corporate bonds, and those are ordinary income tax. That's like a Ford, Apple, Microsoft. They all issue bonds. Ford's pretty big in the bond market. But the question is, what do I like better? Do I like bonds or do I like dividend-paying stocks? And I can tell you that I have purchased more bonds in the last 4 or 5 months than I did in the last 14 years, mainly because rates were so low. You really couldn't buy and hold a long-term bond. From time to time, you can get a decent yield if a company came out or you're looking a little bit low on the credit spectrum. In corporate bonds, they're rated AAA all the way down to not rated, but there's 3 different rating agencies, and if you could get just below the junk rated bonds, so just in the junk territory or less than investment grade, every once in a while you could get a pretty good yield there. But for the most part, we had been buying dividend-paying stocks to get that yield portion of our portfolio. Well, that's kind of over, and I do like bonds right now. Why do I like bonds right now? Well, if you're using government bonds, United States government treasuries, notes, bills, bonds, you can remove a lot of risk from your portfolio. So if I buy a 1-year government note right now, that note is guaranteed by the full faith and credit of the federal government. We've never defaulted on anything. That's your risk-free rate right now, is about 5% on a 1 year. So that's not bad, and I can lock up for a year at 5%. Now, we have an inverted yield curve. Corey's going to put a chart up of an inverted yield curve and a regular yield curve, and you could see this. An inverted yield curve means that the shorter the money is, the shorter the duration, the time frame of the bond, the higher the rate. The longer the bond is before it comes due, the lower the rate. It should be opposite. A regular yield curve is opposite. The longer you have your money at risk, the more you should earn. Well, we have an inverted yield curve right now because the bond market believes we're going into a recession. So I'm staying a little closer to me, a little less time on the bonds. I'm buying a lot of 1-year treasuries. I'm buying some corporates right now. I got some Goldman Sachs last week and some other things. So you got to look on a daily basis, just like the stock market. You got to constantly be looking and doing that, and that's what we do. But you could really use the bond market now to drag a lot of risk out of a portfolio. And because rates are back in vogue, and they're getting more voguer, if I could say, or more in vogue, because they're moving higher. And I don't think it's going to be unheard of to be getting maybe 5.4 in a 1-year treasury by June. And so we'll be buying those things. I like those things. I could do that for a while. And some of that, a lot of that bleeds over into the corporate market. And if you're buying investment grade bonds, if that company hasn't declared bankruptcy and is in business when your bond comes due, you're getting back par value, or $1,000 most likely, in your last interest payment. That guarantee is there if they haven't declared bankruptcy and they're in business. They haven't gone out of business. You're going to get paid back. The federal government is a true guarantee. We've never defaulted on a bond. So I like to use bonds right now and I like the bonds. I haven't bought a bond fund yet, and I'm not against bond funds when we're at the absolute height of the interest rate cycle. I don't think we're there yet. See, the problem with a bond fund is you don't actually own any of the bonds. So if the bond market turns against you and you're losing money in your bond on your statement, you just let it come due. You get all your money back. So you've mitigated some of the risk there. That does not happen in a bond fund because you don't own any individual bonds. So if you buy a bond fund at the top of the interest rate cycle, and think of it a seesaw or a teeter-totter. You have bond values on one side, interest rates on the other. As interest rates go up, bond values come down. As interest rates go down, bond values come up. So if you're at the top of the interest rate cycle and you buy a bond fund, likely scenario is that the Fed is going to come back to us in 2024 and lower interest rates to get us out of a recession that we could potentially be in. Your bond values are going to go up, so a mutual fund could make sense then. I just don't think it makes sense right now, but I know a lot of people don't understand the bond market, so their comfort level is in mutual funds. Just be careful, because there's no guarantees against loss of principal in a bond fund of any kind. It doesn't matter what the bond fund holds. If interest rates move against you, meaning in a bond fund go up, you're losing money in a bond fund. You would also lose money in a bond if you went to sell it, but you don't have to sell it. That's why I like individual bonds, because they have a due date where you get your par value back and everybody's happy. So I kind of like those things. Now, there is a risk in buying bonds in that there's an interest rate risk, a reinvestment risk. That bond could come due in a year like I'm doing, and rates could be lower. So I got to go back into the market at a lower rate, and that is a risk. I think that we're going to be okay. But even if we're a little bit lower right now, we're still pretty good. So I'm willing to take that risk right now. One other question, inheritance of a stock. So just to answer that question, I kind of like bonds right now for a portion of your portfolio, especially if you're older and you've always heard, well, do a 70-30, 65-35, 60-40 split. I could use the 30, the 35, or the 40 in bonds right now and feel relatively comfortable with that. So I like it. And bonds are a way for us to drag a little bit of risk out of portfolio, so I like that too. The inheritance of a stock. If you get a stock as an inheritance, you get what's called stepped up basis. So on the date of death of the person who gave it, the giver, that's the value of your stock for tax purposes. So if you go to sell that stock 3 months later and it's less than that value, you declare a loss. You get a loss on your taxes. So stepped up basis are words to live by. There's been a lot of talk in the past about Congress doing away with stepped up basis, but on inheritances, it's really a great thing. Don't let them do that. If somebody says to you, I'm going to vote against stepped up basis in Congress, vote against that person. Don't let them in Congress. So that's a quick hit right there on that because we're running out of time. But so inherited stock, inherited houses, inherited cars, anything inherited gets stepped up basis, real property. It doesn't work that way on IRAs. IRAs with the new tax laws really got convoluted when they're inherited. So it's not the best money to pass on to the next generation unless it's a Roth. That's easier, and I like that. Spend your regular IRA money first if it's a concern to leave money to the next generation. So let them inherit your house, your non-qualified stocks, all those things, because they get them really clean. The other thing that's great to inherit is life insurance benefits, because life insurance pays out tax-free, and I have yet to see the family who turns away a life insurance benefit. Usually it's needed, so whatever that life insurance benefit is, it pays tax-free to your beneficiaries in 99% of cases. So I am David Safransky, a real American, a true gun-loving patriot, and the voice you can trust.